Today is the 23rd of May 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500. In fact, I'm doing an analysis of the ES futures prices, and we're going to be digging really deep in today's video. I'm very excited about it. We're going to be considering the cyclic model that we are using to perform the analysis. We've got some really interesting things to speak about, so let's go and take a look at the markets. First of all, this is the analysis that we've been looking at for many weeks, months now, in terms of the price movement of the S&P 500. The important features of this particular analysis are the fact that I have influenced the analysis to position the 18-month cycle trough over here at the beginning of October. There is that trough in price. Now, in last week's market update, I think it was, I spoke about the Nifty and I presented something called the initial cyclic model, which was something that Hurst discussed in his workshop-style course, the Cyclic Cycles course that he published 50 years ago, a little more than 50 years ago now. And I introduced the initial cyclic model and I discussed it in last week's market update video. If you haven't seen that video, I would encourage you to go back and take a look at that again, because I do try to avoid repeating myself too much in these videos. In one of the comments, I was asked to please discuss the initial cyclic model in the S&P 500, and so that is what we're going to be doing today. It makes for a really fascinating discussion, and it does raise a very important question which has to do with what cycles are currently influencing this market. Of course, the default cyclic model that we work with was defined by Hurst 50 years ago, based on his analysis of the United States stock market. And it is a model that still works very well because of the fact that when we perform an analysis, we allow for variation in the cycle wavelength. And so it continues to work in many markets, and it has proved to be very reliable. Sometimes, however, it's really useful to focus in on the recent time period and consider the cyclic model afresh, and so that's what we're going to be doing. So in this analysis, we have an 18-month cycle trough, as I mentioned, in October. Of course, we have the very big cycle trough, 54 months or possibly even 9-year magnitude in March of 2020. Now, you will know that I've been discussing recently the fact that the markets have been turning bearish, and that is because we have some bearish cycle shapes. That is a bearish cycle shape. So let's speak for a moment about what I mean by bearishness. Of course, in every cycle, you have a bullish period where markets are rising because of the influence of that cycle, and then you have a bearish period when the markets are falling because of the influence of that cycle. What do I mean by the bearishness or bullishness? Well, what I mean is that when there is some bearishness, the cycle shape gets distorted to the downside. So instead of being a simple up and downward movement, you get an upward movement and then a stronger downward movement, resulting in the cycle trough, or at least the cycle bringing us to a lower trough at the end of the cycle than the level at which it started. That is clearly a bearish shaped cycle. The other feature of a bearish shaped cycle is that the peak tends to occur early. So whereas when you have a balanced cycle, the peak is expected to form at about the midpoint of the cycle, in a bearish cycle, the peak occurs early. The opposite, of course, is true for bullish cycles, but let's not discuss that now because we are in a bearish situation, as I have been discussing for many market updates now. And so you can see the clear signs of bearishness in the current cycle shapes, which are, of course, marked by early peaks. There are the early peaks, and I discussed this, was it last week or the week before? So if you haven't seen those videos, I would encourage you to go back and look at them again. And of course, price has been coming down lower and lower, so we get lower lows and we get lower highs forming, so clearly we are in a bearish market. Now, one of the problems with this, according to the cycle analysis that we have on this chart, is the fact that we are seeing quite so much bearishness in the second 18-month cycle of a much longer cycle, considering that we have such a big magnitude cycle trough in March of 2020. Let's zoom in here and take a look at what's been happening recently. And let's just clear those semicircles that get a bit confusing when you're looking at this kind of detail. So here is the exact analysis that we've been tracking, of course, 18-month cycle trough in early October of last year. Here is the 20-week cycle trough, which I've discussed in previous market update videos. I believe is best positioned over here on the 8th of March, I think it is. If we count the number of days that have elapsed since that trough formed, you can see there have been 76 days that have elapsed since that 20-week cycle trough. According to the analysis, you can see here at the foot of the chart the nest of lows for an 80-day cycle. And this is what we've been discussing for some time, the fact that the markets are coming into an 80-day cycle trough. Here is the circle and the whiskers to each side of the circle for the 40-week cycle trough. And so as discussed in last week's video, it is possible, just possible, that we are already going to be experiencing, or at least prices already moving into, this 40-week cycle trough. So that's the situation in terms of what's happening. What is the average length of an 80-day cycle? You should know this by now. It is 68 days, and so we are already 8 days overdue. Is that unexpected in a bearish market? No, it isn't, because troughs tend to occur early in bullish markets, whereas peaks occur early in bearish markets and troughs occur late. But as I have been saying time and again, we are in a bearish market, and the bounce out of the 80-day cycle trough might be a very disappointing one. Is it possible that the 80-day cycle trough lies behind us? Is it possible that this was the 80-day cycle trough? It is unlikely, in my opinion. I think it is much more likely that the 80-day cycle trough is still going to form, or just possibly it formed on Friday. We had a bit of a spike down on Friday, but we would need price to cross up above this 20-day FLD. We have witnessed a very unusual sequence of 3 occasions at which price found resistance at the level of the 20-day cycle FLD. That is very unusual. I can't think when last I saw a sequence of 3 interactions between price and the FLD. Again, it's another sign that we are in a bearish market. You will notice, according to this analysis, that the 40-day cycle trough formed over here in about the middle of April. The interaction that we would expect after the 40-day cycle trough would be where price crosses above the FLD and achieves its target to the upside. That clearly failed to happen. That kind of failure is an indication of bearishness, because of course the sequence of interactions between price and the FLD is no more than a measure of the way in which the cycles are influencing price. And so when price comes up to the FLD and is expected to cross above it but fails to do so and doesn't get anywhere near its target, it is a warning that the markets are more bearish than might be expected. And so that was a bearish sign. I received some emails this week about whether we're witnessing a triple GH category interaction. For those of you who understand the sequence of interactions, in my opinion, no, we're not witnessing a triple GH category interaction, but this was a failed E and then F category interaction over here, and what we have seen since then is a double GH. Okay, so we are now expecting price to cross above the 20-day FLD. But as I have said repeatedly, when we are in a bearish market, we need to be really careful about the fact that identifying cycle troughs can be difficult. And so this is our analysis situation at the moment. If we display the composite model line, which gives us an indication of what is expected because of the cycles that are influencing the price action, you can see that we are now expecting the bounce out of the 80-day cycle trough, as we have been expecting, or we've been looking forward to for some time. But then, of course, the bigger message is that because we're in a bearish market, the bounce out of this trough is likely to be disappointing, and the move to concentrate on is definitely going to be the downwards move as we come into the 40-week cycle trough. But now let's zoom out and add the semicircles in again so that we can visualize what the analysis is telling us. Here is the 80-day cycle trough nest of lows, which is what we're expecting to form now. Here is the 40-week cycle nest of lows. And so, as mentioned and demonstrated by the composite model line, we're expecting a small bounce out of the 80-day cycle trough and then a move down into this 40-week cycle nest of lows, which is expected in about July. But what is going to happen then? Well, of course, price will bounce out of the 40-week cycle trough. But take a look at this semicircle for the 18-month cycle. You can see that when the 40-week cycle trough forms, the 18-month cycle is itself forming a top or a peak in the markets. That is to say that the influence of the 18-month cycle, which should have been bullish throughout this period of time, let me draw an arrow here to indicate the bullish influence of that 18-month cycle. That bullish influence is going to turn bearish, which means that in fact we're looking forward to more bearishness as the market is expected to continue further down according to this analysis. Now, a Hurst cycles analysis is a fairly complex puzzle of all the multiple cycles and how they fit together. And it can be a little overwhelming to try to understand what the implications are. One way of understanding the implications of an analysis are to take a look at these semicircles on the chart, because they provide us with some visual information in terms of whether each one of the cycles is influencing price to move upwards or downwards. Another way to understand the implications of the analysis are, of course, to take a look at the composite model line. But let's go back to what Hurst himself recommended doing, which was to take a look at something called the cyclic model. Let's consider the cyclic model for this analysis. Here it is. Now, a cyclic model is very simply a table. The left-hand column, as you can see, is titled nominal. This is the nominal cycle length, and this is the default cyclic model that Hurst defined 50 years ago. For each one of the cycles, we have first the cycle name, such as you can see 20-week, and then in brackets after that 19.5. The figure in brackets is the average wavelength that cycle is expected to run at. So as I've mentioned in many of these videos, we call the 18-month cycle, for instance, the 18-month cycle, whereas the average wavelength is 17.9 months. It's easier to say 18 months than to walk around saying the 17.9 month cycle. The next column is the actual recent wavelength. As you can see, that differs from the average wavelength in the first column. The reason is because of the principle of variation. These cycle wavelengths are dynamic. And this is the actual wavelength that has been found in this particular analysis. As I mentioned, the principle of variation allows us to analyze a market even if the actual wavelengths don't match exactly the average wavelengths in our nominal model that we are using to perform the analysis. The next column is the variation column. That tells us in terms of percentage how much the actual wavelengths have varied from the nominal wavelengths. You can see that these longer cycles have varied by an amount of 16%. The 18-month cycle has varied by an amount of 28%. That's a fairly big variation. And the shorter cycles, you can see their variations over here, are not nearly as big in terms of their difference from the average wavelength. The next column shows us how far along we are from the most recent trough of that cycle. And then the status, the final column over here, shows us by a simple graphical means of an arrow whether the cycle is moving up, such as this green arrow over here, or whether it is moving down, these red arrows over here, or whether it is turning up or turning down. We don't have any examples of a cycle turning down. The advantage of this table is it gives us a very easy way of seeing at a glance what each one of these cycles are doing. In recent market updates, I've been speaking about the fact that this 18-month cycle is looking more bearish than would be expected. Why would we expect a more bullish 18-month cycle according to this analysis? It's very simple. You look at the longer cycles. And if the longer cycles are moving up, as they are here, the 54-month cycle and the 9-year cycle, according to this analysis, are both moving up, and also sigma L, which is the sum of all cycles longer than the longest cycle found in the analysis. So all three of those cycles are pushing up. When you have three cycles pushing upwards, you would expect a bullish-shaped cycle. And that is the anomaly that I've been discussing in these market update videos. And so I hope you can see from this quick description why it is an anomaly. But now let's consider a different cyclic model. Hurst recommended that you build what is called an initial cyclic model. And indeed, Sentient Trader does that for each and every one of its analyses. The way in which you do it is you start with a form of spectral analysis. So let's take a look at the spectral analysis that has been performed on this chart and consider the results of that. Hurst displayed the results of the spectral analysis that he performed on the charts by means of what he called a periodogram. This is in fact a periodogram plotted in exactly the same way that Hurst himself plotted it, and based on a fairly simple form of spectral analysis, which is actually based on the exact form of spectral analysis that Hurst himself used. I won't go into the details about how I know that, but the results of the spectral analysis provide us with information about the cycles that are present in the data. So you can see it looks a little bit like a city skyline. The tallest buildings represent high probability of a cycle of that wavelength being present in the data. And so we can highlight some of those taller buildings over here. And so the way that we build an initial cyclic model is that we start with a structure in terms of the harmonic ratio that we are expecting between the various cycles. And that structure is based upon the nominal model that Hurst defined. In particular, we have an 80-day cycle. Now, the average length of the 80-day cycle, according to Hurst's nominal model, is 68 days. That is approximately 68 days on our periodogram. You can see there is a little bit of evidence that a cycle is present at that wavelength, but there is more evidence that there is a cycle shorter than it or longer than it. There is also here a fairly clear cycle at this wavelength over here, which is, just under 90 days, I think, 89 days or something like that. This points out a danger with working with the results of a spectral analysis, is that often you can get evidence of a cycle forming, whereas in fact that cycle is probably a combination of two cycles. And so it is likely that that peak is the result of the combination of an 80-day cycle and a 40-day cycle or something like that. Let's consider the next cycle in Hurst's nominal model, which is the 20-week cycle, which has an average length of 136 days. There is 136 days on our periodogram, and again, we have an apparent cycle that is shorter than that length, coming in at about 118 days, and also a cycle that is longer than that, coming in at about 139 days. The way that Hurst recommended building your initial cyclic model was to take a look at the evidence presented in the periodogram, identify cycles that are close to the expected average wavelength according to the model that you're working with, and then to build a matching model, matching in terms of the harmonic ratio between the cycles, which he called the initial cyclic model. You would do this for the daily data and also the weekly data. Here's our weekly periodogram, and also the monthly data. This is our monthly periodogram over here. As a matter of interest, when we were taking a look at the cyclic model table, the 54-month cycle was running fairly long at something over 60 months, and there is evidence of that cycle. There is also a possibility that that cycle has in fact been running short at a length of about 48 months. Now, as you can imagine, this is a fairly time-consuming process, but Sentient Trader does perform it for you. And you can ask Sentient Trader to base the analysis on the chart on the initial cyclic model or the nominal model. Mostly in these market update videos, I present an analysis based on the default nominal model because, as mentioned, we do give the wavelengths of the cycles quite a lot of breathing room because of the principle of variation. And over time, the default nominal model usually provides the best analysis. Nevertheless, it is very useful to take a look at an analysis performed using an initial cyclic model, so let's do that for the ES. So here is the results of the analysis performed using the initial cyclic model. Now, I'm not going to go into too much detail, but you can see that this analysis is making quite a lot of sense, with a 9-year cycle trough in 2002, another one in 2009, and then another one in 2016, and the next 9-year cycle trough is looming ahead of us. You can see there's a bit of a discrepancy there in terms of exactly where that 9-year cycle trough is going to fall. What this analysis does tell us is that the 54-month cycle trough, and let me just zoom in, the 54-month cycle trough formed in March of 2020. Nothing different there. But the interesting thing here is the position of the 18-month cycle trough, which you can see has been positioned over here in June of last year. A very experienced Hurst cycles analyst, also called David, who has been posting to our analysis blog, has been speaking about the 18-month cycle trough forming in July of last year. And so this makes for a very interesting analysis situation. Let's consider a few things about this analysis before we take a look at the details. First of all, a quick glance at the right-hand edge of the chart shows us a different picture in terms of the average wavelengths that have been found. Let me zoom in so we can see those wavelengths a bit more clearly. Here you can see on the right-hand edge of the chart the different average wavelengths that have been found. The 80-day cycle has been found to be of 52 days in length, 20-week cycle only 16 weeks, and the 40-week cycle 32 weeks. The reason for that is because we are working with a different nominal model. So let's take a look at the cyclic model as we did on the other analysis. Here is that cyclic model. The first thing that you will notice immediately is that the wavelength figures in brackets after the name of the cycle are all different to the average lengths that are used in the default nominal model. In particular, the 18-month cycle, according to the initial cyclic model, has been only 13.7 months in length. The 40-week cycle is closer to 30 weeks, 29.8 weeks. The 20-week cycle is 15 weeks, and so forth. You can take a look at all those numbers over there. The other interesting thing to observe is the variation column, which presents the fact that each one of these cycles, every one of them has a negative value, has been beating with a shorter wavelength than the nominal model upon which this initial cyclic model is based. But the most important message perhaps about this initial cyclic model is one that immediately jumps out at you, and that is that every single one of these cycles is red in color. In other words, every single one of these cycles is currently influencing price to move down, except for sigma L. And if we take a look at the arrows over here, you can see that the 9-year cycle is expected to be turning up. So in other words, it is still moving down. The 54-month cycle is moving down. The 18-month cycle is moving down. The 20-week cycle is moving down. All of those cycles are moving down. These cycles are expected to be turning up. Now, when a cycle is expected to turn up, that means that it is, of course, still moving down, and it is expected to turn up fairly soon. And so to come back to the question of why the current 18-month cycle is bearish as opposed to being bullish in shape, that is again answered over here. We have a downward pointing 54-month cycle. We have a downward moving 9-year cycle expected to move up. And sigma L, which is perhaps the least reliable of all of this information, is still moving up. Why is sigma L moving up as a matter of interest? Well, if we zoom out on the chart, it is fairly obvious why sigma L is considered to be moving up. If we take a look at this analysis, we can see that the 9-year cycle is, of course, currently pressing downwards. There we go, which explains some bearishness in the market. However, the markets have been moving up fairly strongly, as you can see, obviously, from the March 2020 trough. And it is that combination of a very strong upwards move, considering the fact that the 9-year cycle should be pressing downwards, that gives us a positive sigma L. But now let's zoom in on this analysis and consider what it is telling us to expect now. As you can see, according to this analysis, the trough that the markets are currently moving into is of 20-week magnitude. And so whether we are looking at an analysis performed with the default nominal model or this initial cyclic model, we are expecting a trough to form. If we display the composite model line, you can see that it matches price action fairly well, and it is telling us to expect a move up, but again, not a very impressive move up. Why? Because it doesn't matter which analysis we're looking at. Both of them are telling us that we're in a bearish situation, and so we're looking for a fairly small bounce out of this trough of 20-week magnitude, according to this analysis, followed by a move down. Let's zoom out a little bit so that we can see that move down in some more perspective. Here is our fairly insignificant bounce out of the 20-week cycle trough. Then we're going to have price moving down into the same period of time that we are expecting a trough in the other analysis, that is in July of this year. Then we're going to experience a fairly small and disappointing bounce out of that trough, followed by another move down into a deeper trough over here in September. One of the reasons that I find Hurst cycles analysis so powerful is that no matter which analysis we are working with, we can draw fairly similar conclusions. Both of these analyses tell us to expect a fairly disappointing bounce out of the trough that should be forming now. Whether that trough is of 20-week magnitude or 80-day magnitude, we can come back to after it has formed. The point is that it is going to be a fairly disappointing bounce. Both analyses warn us to expect a further move down into July. And that is where these two analyses begin to differ, because this analysis warns us to expect a disappointing bounce out of July, followed by a deeper move down into September. However, the other analysis would expect a bigger bounce out of the trough in July. We have several weeks to go until that trough in July, and so I will continue to monitor the analysis and update you in these market updates so that we can develop more confidence in terms of what we are expecting in July. This analysis, however, provides a very timely warning that we might have only seen the very beginnings of this bear market and that we could see much more bearish price action all the way into September of this year. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.